If you own silver, you need to hear this before the next 72 hours pass. Something is moving beneath the surface of the global economy right now, something most investors are not being told. While attention stays fixed on gold's headlines, a quieter, more dangerous shift is unfolding in the silver market. Supply chains are straining. Industrial demand is colliding with a shrinking stockpile, and a decision made in the next 3 days could determine who protects their wealth and who is left explaining too late what they missed. Stay until the end, because what happens next may not repeat itself for years. Welcome back to Precious Metals Intelligence, the channel built for those who prefer facts over noise and preparation over panic. If you are new here, this channel exists for one purpose: to help serious, wealth-conscious viewers understand the economic forces shaping their future before those forces become headlines. Before we continue, it would help our small community to know, where are you watching from today? Drop your city or country in the comments below. It always means a great deal to see how far this analysis travels. Most people are watching the wrong metal. For months, the financial world has kept its eyes fixed on gold. Every headline, every analyst report, every dinner table conversation about protecting your money seems to circle back to one topic. Gold hit record highs. Gold dropped sharply. Gold is expected to climb again. It is understandable. Gold has always carried a certain weight in the public imagination. It feels safe. It feels historic. It feels like the obvious answer. But while everyone stares at gold, something quieter is happening just beside it. And it is happening to silver. Silver does not get the same attention. It does not make the same dramatic headlines. Yet in many ways, it carries more pressure than gold does right now. To understand why, one has to understand something simple but important. Silver is not just a monetary metal. It is not simply a store of value that sits in a vault. Silver is also an industrial metal. It is used in solar panels, in electronics, in medical equipment, in electric vehicles, and in dozens of technologies that modern economies depend on every single day. This dual identity is what makes silver different. Gold is mostly bought and held. Silver is bought, held, and also used up. Factories consume it. Technology companies need it. Once it disappears into a solar panel or a circuit board, it does not easily come back into the market. This is a detail many casual investors overlook, but it matters enormously. At the same time, the broader economic picture is under strain. Inflation has not disappeared. Currencies continue to weaken against real physical assets. Energy markets remain unstable, and that instability is not contained to oil and gas alone. When energy prices rise, the cost of mining and refining metals rises with them. Digging silver out of the ground, processing it, and transporting it all becomes more expensive. That added cost does not vanish. It works its way into the final price, slowly, quietly, but consistently. Meanwhile, supply chains around the world remain fragile. Shipping routes have been disrupted. Certain regions that once reliably exported raw materials have become less predictable. These disruptions rarely make front-page news once the initial shock passes, but their effects linger far longer than most people realize. Businesses that rely on steady metal supplies are forced to adjust, and those adjustments often mean higher demand for whatever supply remains available and reliable. This is the environment silver finds itself in today. A metal needed by industry, a metal historically valued as a store of wealth, a metal caught between rising costs, tightening supply, and a public that is mostly distracted by gold's louder story. And this is exactly why the next 72 hours matter. Markets do not move only because of slow, steady trends. They often move because of specific moments. A report released, a decision announced, a number confirmed that either matches expectations or breaks them completely. These moments can turn a quiet, overlooked market into the center of attention almost overnight. Silver has been quietly building pressure in the background for some time now. The question is not whether that pressure exists. The question is what triggers its release and when. For business professionals, entrepreneurs, and anyone who has spent years building financial stability, this kind of moment deserves attention. Not panic, not fear. Attention. The people who tend to protect their wealth most effectively are rarely the ones reacting after a headline breaks. They are the ones paying attention before it does. So while the rest of the financial world remains focused on gold's dramatic swings, a smaller, more informed group is beginning to ask a different question. Not what is gold doing, but what is silver about to do? That question becomes far more urgent when specific, near-term events are lined up to test the market's current balance. And that is exactly where this story turns next. Because in the next 72 hours, something is expected to happen. Something tied directly to supply, demand, and a market that has quietly grown tighter than most people realize. What that event is, and why it matters so much, is where the real story begins. Beneath every quiet market, there is usually a number that nobody's talking about. For silver, that number is supply. And right now, that number is shrinking in ways that deserve far more attention than it is getting. To understand why, it helps to start with the mines themselves. Silver is rarely mined on its own. Most of the world's silver actually comes as a byproduct of mining other metals, especially copper, zinc, and lead. This means silver production does not simply rise and fall based on silver's own price. It depends heavily on decisions made in completely different industries. When copper mining slows down or when zinc demand shifts, silver output can shrink almost as a side effect, even if silver prices themselves are rising. This is a strange and often misunderstood part of the market, and it creates supply problems that are difficult to fix quickly. On top of this, the quality of the ore being mined has been declining for years. Easily accessible, high-grade silver deposits have already been discovered and extracted over past decades. What remains is harder to reach, more expensive to process, and often located in regions with political or logistical challenges. Mining companies must dig deeper, invest more, and wait longer to bring new silver to market. None of this happens quickly. A mine that needed more investment 5 years ago cannot simply speed up production today because prices are rising. The physical and financial reality of mining does not work that way. At the same time, demand is moving in the opposite direction. Solar energy has become one of the largest new sources of industrial silver demand in the world. Each solar panel requires a small amount of silver to function efficiently, and as countries continue building solar infrastructure at record pace, that small amount adds up to an enormous total. Electric vehicles add another layer of demand, since they use significantly more silver in their electrical systems than traditional vehicles. Add in electronics, medical devices, and other technologies, and industrial demand for silver has been climbing steadily, year after year, often quietly, without much public discussion. This creates a very specific kind of pressure. Investment demand and industrial demand are now competing for the same limited supply. In the past, someone buying silver as an investment was mainly competing with other investors. Today, they are also competing with solar companies, electronics manufacturers, and automakers who need the metal simply to build their products. This is a fundamentally different kind of market than the one many people still imagine when they think about silver. There's another detail that deserves close attention. Above-ground silver inventories. These are the stockpiles held in vaults, warehouses, and exchanges around the world, representing readily available supply. For years, these inventories acted as a buffer. When demand increased suddenly, the market could simply pull from these existing stockpiles rather than relying entirely on new mining output. But that buffer has been shrinking. Year after year, more silver has been withdrawn than replaced. When a buffer like this becomes thin, markets lose their shock absorber. Small disruptions that once passed quietly can suddenly cause noticeable price movement. History offers a useful, calm lesson here. In past decades, whenever supply tightened sharply while demand continued rising, silver prices did not move gradually. They moved suddenly, often catching casual observers by surprise. This is not a dramatic prediction. It is simply how markets with limited supply have behaved before, again and again, across different decades and different economic conditions. This is the structural backdrop now colliding with a very specific, near-term event. It is one thing to understand that silver's supply is tightening over years. It is another to understand that a particular moment, arriving within days, could act as the spark that reveals just how tight that supply has become. Business professionals and serious investors rarely react to slow-moving trends alone. They react when a slow-moving trend meets a specific trigger. Silver has spent months, even years, building this kind of quiet pressure. The mining constraints are real. The inventory decline is real. The competition between industrial use and investment demand is real. What remains is the timing. And that timing is what brings this story to its next, more urgent stage. Because the pressure building beneath the surface is about to meet a moment that could test it directly. There is an old number that traders have watched for generations, and lately it has been sending a signal that few casual investors understand. That number is called the gold to silver ratio. It simply measures how many ounces of silver it takes to equal the value of 1 ounce of gold. It sounds like a small technical detail. In reality, it has quietly predicted major shifts in precious metals markets for decades. Historically, this ratio has moved within a fairly recognizable range. When it climbs to unusually high levels, it often means one of two things. Either gold has become expensive relative to silver, or silver has become undervalued relative to gold, or both are happening at once. In past economic cycles, extreme readings in this ratio have often come before periods where silver moved sharply to catch up with gold's performance. This is not guesswork. It is a pattern that has repeated across multiple decades through different governments, different currencies, and different global crises. Right now, this ratio sits at levels that many analysts consider historically stretched. Gold has spent the past year dominating headlines, swinging dramatically from record highs to sharp pullbacks and back again. Every one of those swings pulled attention, capital, and conversation toward gold. Silver, quietly sitting beside it, has been left out of most of that public discussion. Yet the fundamentals discussed earlier, tightening supply, rising industrial demand, shrinking inventories, have continued building regardless of where public attention happened to be pointed. This creates what analysts often describe as a valuation gap. Gold's price movements have been loud and visible. Silver's underlying pressure has been quiet and structural. When a gap like this widens too far, markets have historically found ways to close it. Sometimes that happens gradually over many months. Other times it happens quickly, once a specific trigger forces investors to reconsider where their attention should have been all along. It is important to be clear and honest here. This is not a guaranteed outcome. No serious analyst can promise that history will repeat itself exactly, or that any specific price target will be reached on any particular date. What can be said, calmly and factually, is that extreme readings in this ratio have, throughout history, been followed by periods where silver's price behavior diverged sharply from its recent quiet pattern. That is an observation grounded in decades of market data, not a promise about the future. There is also a broader institutional pattern worth understanding. Central banks and large financial institutions have spent recent years increasing their attention on precious metals as part of broader strategies to manage currency risk and diversify away from traditional paper assets. Much of the public conversation around this trend has focused on gold, since central banks tend to report gold purchases more visibly than silver activity. However, institutional behavior toward one precious metal often signals a broader philosophy toward metals as a category. When large financial institutions shift toward viewing metals as essential strategic assets, it rarely applies to only one metal in isolation. This does not mean silver will automatically follow gold's exact path. Silver behaves differently because of its heavy industrial use, something gold does not share in the same way. But it does mean that the broader shift in how large financial institutions think about precious metals creates an environment where silver is far more likely to receive renewed attention than it would have received in previous decades, when industrial demand played a much smaller role. All of this builds toward a larger point that ties directly back into the story's central warning. The structural supply pressures already discussed are not happening in isolation. They are happening at the exact moment when the historical relationship between gold and silver suggests silver is unusually undervalued. Two separate forces, one based on physical supply and demand, the other based on decades of historical pricing patterns, appear to be pointing in the same general direction at the same time. For business professionals and serious, wealth-conscious individuals, this kind of alignment deserves calm, careful attention rather than emotional reaction. Patterns like this do not appear often. When they do, they tend to draw a specific kind of investor, one who values preparation over prediction and awareness over assumption. And this is precisely where the story now turns toward something far more immediate. Because structural pressure and historical patterns are one thing, a specific near-term catalyst arriving within days is something else entirely. That catalyst is where this story goes next. Every market story eventually reaches a moment where slow-building pressure meets a specific immediate trigger. For silver, that moment is arriving now. Throughout this story, two patterns have been building quietly in the background. First, the structural supply pressure, shrinking mine output, rising industrial demand, and thinning inventories. Second, the historical pricing pattern, an unusually stretched gold-to-silver ratio that has, in the past, come before periods of sharp adjustment. Both of these forces take time to build. Neither of them, on its own, explains urgency measured in hours rather than months. That is where a near-term catalyst becomes important. In financial markets, prices rarely move simply because underlying conditions are tight. They move when something forces the market to confront those conditions directly. This can come in several forms. It might be a major economic data release, such as inflation figures or employment numbers, that shifts expectations about interest rates and currency strength. It might be a decision from a central bank regarding monetary policy. It might be a supply disruption, a shipping delay, a mining announcement, or a geopolitical development that suddenly limits available silver in the short term. Sometimes it is simply a moment when enough large buyers act at the same time, revealing just how thin the available supply has actually become. Whatever the specific form, catalysts like this share a common effect. They convert quiet, background pressure into visible, immediate price movement. And when supply is already tight, as it has been shown to be with silver, that movement can happen quickly and without much warning to those who were not paying attention beforehand. It is worth pausing here to explain honestly and clearly that there are two very different ways a price shock like this can unfold. One is a supply-driven shock, where physical availability of silver suddenly tightens further, forcing prices upwards simply because there's not enough metal to meet existing demand. The other is a demand-driven shock, where a sudden rush of buyers, whether investors seeking safety or industries securing supply, overwhelms a market that was already thin on inventory. In practice, these two forces often combine. A market that is already supply-constrained becomes especially sensitive to any sudden increase in demand, because there is little cushion left to absorb it. This is precisely the environment silver finds itself in today. The cushion has been thinning for years. The historical valuation gap between gold and silver remains wide, and now a specific near-term event is positioned to test whether that thin cushion can hold. It would be irresponsible to present this as a certainty. No analyst, no matter how experienced, can guarantee the exact outcome of any single event within a fixed 72-hour window. Markets are influenced by countless factors, and short-term price movements can be unpredictable even when underlying conditions strongly favor one direction. This story is not a promise of what will happen. It is a calm explanation of why so many of the necessary conditions for a significant move are currently aligned at the same time. What history does show consistently is that moments like this tend to separate two types of people. The first group only pays attention once prices have already moved sharply, often after the most favorable entry point has already passed. The second group pays attention beforehand, not out of panic, but out of preparation. They understand the structural story. They understand the historical pattern. And when a specific catalyst arrives, they are not surprised by it. They already understood why it mattered. This distinction is not about predicting the future with certainty. It is about understanding probability, pattern, and timing well enough to make informed decisions rather than reactive ones. That has always been the difference between those who are caught off guard by market shifts and those who move calmly ahead of them. And that difference is exactly where this story now turns, toward its final and most important part. What informed, wealth-conscious individuals typically choose to do when a pattern like this has appeared before.